I'm sure you've heard everyone and their brother out there talking about how real estate is the key to creating wealth. Well, stick around because we're going to give you the reasons why.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. And today, like I mentioned, we are bringing you guys the upsides to real estate, the reasons why you guys want to consider investing in real estate in 2024 and beyond.
You know, this is in conjunction with a video or a podcast we did about a month ago where we talked about the downside of real estate. And we like to share both sides, even whether it's infinite banking, we share the pros and cons, as well as real estate. So last time we started with the cons, and now we're going to start with the advantages.
We are. I'm excited. We've got a list, right? And that we created of, I think, 10 different upsides to real estate. We divvied those up. I got the good ones. You got the bad ones. So, Anthony, I'm going to throw it to you first.
I think I got the more complex ones. But anyways, I would say one of the many reasons why we like real estate is it's a form of diversification. Most people willing to bet most or maybe all of their assets or net worth is tied up into the stock market.
Yeah.
Or hopefully they have a business. So maybe it's between those two, but having some of your net worth in the asset class of real estate will allow you to diversify. Particularly, it's not so much tied to the stock market, which I think most people have their assets. Cameron, what's one that you're going to share?
I'm going to take the easy one. I'm going to hit this out of the park. We're going with cash flow. Anthony, cash flow, the number one reason why people like real estate. Cash flow is what you're left over with at the end of the month after you take in all your income and you pay all your expenses. That difference right there is going to be your cash flow. I've given three reasons. I'm going to give three reasons why cash flow is so important. The first one is pretty basic, but we've got to be making more money, have more money coming in than we have going out at the end of the month. That reminds me of Anthony's quote a couple of weeks ago when he said, the bottom line
is the bottom line.
Right? We got to have more money coming in than we have going out. So that's the first and foremost, the most obvious. The second one is that cash flow creates opportunities. And if you have cash flow coming in, right, you have the ability to turn around and reinvest those profits into another avenue or into another investment. And you can exponentially increase your financial abilities moving forward. So cash flow creates opportunities. And the third one I want to share with you guys is cash flow creates safety. When you have cash flow that's coming in, you're able to replenish your reserves after deploying capital to acquire that asset, right? It's just something that you have to do because let me tell you, life is going to happen. You're going to have unexpected expenses that come up on the personal side as well as the business, and you better have capital reserves, and cash flow puts you in a great position to withstand those. Cash flow.
Cameron, the next one I'm going to talk about kind of coincides with that.
Okay.
And meaning investing in real estate can be a passive strategy, right? With that cash flow, that's what we need to get. Well, we define financial freedom as your passive income is more than your monthly expenses. Now, you've probably heard some horror stories about real estate.
Yeah.
I know that I have, and that was one thing that really deterred me from real estate. I kept on hearing these horror stories of people trying to manage the property or trying to move these tenants out. But it can be, if you're done right, can be passive, because what we're really worried about, what those people are worried about, is what we call tenants, toilets, and termites. I mean, who wants to deal with any of those three? You don't have to. You can outsource that to a property manager. And there's also, we've talked a lot about turnkey real estate where it's extremely passive. I mean, there's always a little bit of input, right? Don't just say you're not going to do anything, but you don't have to worry about managing it. And for example, on one of my properties, I had to evict 2 tenants in a row. And the second one just did not want to go. After the eviction, they appealed it, but we eventually got them out. And also on that property, it's interesting. It's the same one. I had 9 bullet holes.
Ooh.
Right.
Ooh. No wonder why I didn't want to go outside.
Right. You didn't want to leave, right?
I'm not going outside either.
But when you hear those at a surface level, that sounds terrible, awful, stressful. Nobody wants to deal with that. I didn't have to lift a finger. Like, I knew I had a strong property manager. They handled the eviction process. They fixed the bullet holes. They did everything. Now, I'm the money man, so I didn't collect rent during that time, and I had to pay for the bullet holes. So it's not all roses, but as far as it being passive, you have a good property manager, this can be a passive way to create that passive income.
Man, you're getting nuggets. Now, I'm going to make a shirt for you that says, "I'm the money man." This is good stuff. And second shirt, we're going to have a merchandise line here pretty quick.
I know. We've been talking about it.
And one that says, "The bottom line
is the bottom line."
All right, Anthony, thanks for teeing it up. I'm just going to go
what do you got?
Yep.
Do you have anything?
Yeah,
Okay.
I've got a couple more. I'm going to go to everyone's second favorite, which is going to be leverage, right? One of the best aspects of real estate is that you don't have to come in with the full price, the full market price of whatever you're buying, right? Is you can come in with just a down payment and you can finance the rest, which, correct me if I'm wrong, there's very few other assets that have that aspect to it. And so real estate is very appealing because of the ability to leverage. Leverage means that you're going to use someone else's money to help finance a portion of that purchase. And there's many different options that are available to you guys that are out there. I'm going to list a few of them here, and I'll give you maybe some description of them as you guys are listening. And if there's any of these financing options that you guys are interested in, feel free to reach out. We'll put you in touch with the right individual, the right lenders. We know many of lenders that fall under each of these categories. So if you guys are out there looking to buy real estate, like the idea of leverage, you want to finance a property moving forward, here's some options that are available for you in terms of lending. One is conventional loans, right? They're offered by banks and credit unions that follow guidelines set by Fannie and Freddie. The down payment that you're going to need is probably in the range of 15 to 20%, and the rates are very competitive. There's also a FHA multifamily. These are available for properties with 2 to 4 units. These loans are backed by the FHA, and typically it's a very low down payment of 3.5%-ish, but the borrower would be required to live in one unit for at least 12 months. VA multifamily is another loan that's available for active duty service members, eligible spouses, and veterans. Down payment is typically 0, and there's no minimum credit score. Portfolio lender, right? We just introduced a client to a gentleman here. But small local lenders that typically keep the mortgage loans they originate on their books, and the loans and the terms may be more flexible and designed to fit the applicant's needs. This is an option for borrowers with low credit score or high debt to income ratio. Private lenders, right? These are fellow real estate professionals who prefer to invest in debt versus equity. Private lending borrowers will typically pay points up front and a higher rate, but have much faster funding timelines. Also, there's group investing, where some investors will bypass banks for a real estate LLC or an LP to raise money to invest in real estate. And instead of an individual borrower, the LLC owns the properties and the investors own shares of the LLC as members. And then finally, probably one of the most common is going to be the HELOC. This is using one's equity in their primary residence as collateral to secure a line of credit with a bank. Works very similar to a credit card, and typically you can have access up to 80% of the equity in your primary residence. Again, those are 7 or 8 different options that you guys could be considering when looking at financing an investment property.
One of those that's just a great example of all the options that you can to leverage. One of the things you mentioned is a brand new option, meaning that if you in a duplex or a triplex or fourplex, if you live in it for a year, you only need to put 3 to 5% down. Only catch is you have to live in it for a year. If you're somebody just starting out, this is a great opportunity. If you could get into a rental property, very little down, And I bet if it's structured right, that the tenant will be paying the entire mortgage or at least close to it. But there's just a lot of ways to get in the game. And Cameron, as you were talking about the leverage, I think that is such a great advantage of real estate. And in essence, what you're doing is you're spending a quarter to get a dollar.
Mm.
I was thinking as we were preparing for this, what other asset class can you buy in installments?
Mm.
The only one I thought of is potentially a business. But again, it's just another advantage in what makes real estate unique.
Yes, thanks. Thanks for repeating what I said. Go ahead, Anthony.
Yeah, okay. Now, and even better, that is a good reason. So
leverage is great.
Leverage.
I'd like to see what you got in terms of leverage. Can you beat that?
Of course, I'll beat anything you can throw down. But right now, we're going to talk about another aspect we like about real estate is appreciation. Now, historically, real estate has grown over the last 30 years. And what we did here.
You got a chart for us.
I got a chart.
I like it.
Let's see. Okay. This is a chart that shows the price of homes over the last 30 years. And a couple of things that I noticed, it pretty much tenuously going up. I mean, there was the great recession where it went down, but overall, typically, it is continually going up. In addition to for just a natural historical appreciation, if you can buy it right, make some improvements, those returns can be even higher. But also, if I tell you, one of my favorite podcasts we did is when we had a demographer on, and it might be good to have him back. One of the many things he shared is that we don't have enough homes.
Yeah.
For two reasons. After 2008, they really stopped building new homes, but also he had a great job of explaining about the impact of the next generation and then how the millennials are the largest generation we've had. And they're now in the process of going out and starting to buy homes. So we had the largest generation going to buy homes, but we haven't been building them. So that, I think there is some built-in appreciation. Also, I tell you, I was surprised when interest rates shot up, the value of the homes maintained. Okay, what do you think is going to happen as these rates go down? I think it'll be more affordable for people to buy homes. And I also think people are sitting on the sidelines. They don't want to sell because they're sitting on a 3% mortgage and they don't want to buy another house and then have to pay a higher interest rate. When things start settling down, I think that's only going to improve the appreciation. Cameron, what's your next item you're going to share?
Anthony, great point on appreciation. I'm going to piggyback on that. I'm going to say less volatile. Right. So you shared a nice chart that was kind of a nice, steady, right? There's a little dip there in the 2000s, but it was going up over time. And I will tell you that the volatility of the stock market, at least the short-term volatility of the stock market, is one of the aspects that turns a lot of people away from investing, right, in that asset class. And people typically will turn to real estate as opposed to stocks, right, is because you can see historically this thing is going to go up. There's not that crazy fluctuation that you see. There's some corrections here and there, but nothing close to what you'll see in the stock market. Also, I did find an article. It was according to a Gallup poll that was published in May 2023. And it said that 34% of Americans believe that real estate is the best long-term investments due to their historically consistent returns, right? So people are looking for something that's less volatile. Yeah. Anthony, how about you?
I would say the next one I have is a lot of people are worried about inflation. And typically real estate is viewed as a hedge against inflation.
Oh, good one.
Okay. So not only is it going to increase with appreciation, it should also increase with inflation, as will all real assets, right? True inflation is really an increase in the money supply. And as there's more dollars printed, each one has less value. But when we have real assets, as they print more dollars, that value of the asset is holding its value. So it's going to take more of those inflated dollars. And what I think is also interesting, I'm just talking about the value of the home. Let's talk about rent. Well, before we do, I'm going to share an article.
Oh,
and Cameron, I'm actually going to.
I like how you referenced. You're showing it.
Okay, I'm going to share this article where it talks. The headline is "Renters are being hit harder by inflation than homeowners are," and there's a great little piece in here. It said 2 things are driving the divide between how homeowners and renters experience inflation. First, most homeowners' monthly payments have not risen. However, the cost of renting has surged. Rent jumped 11% in 2022 from the year before. It also climbed higher in 2023. As of November, the price of rent nationally was up 22% compared to pre-pandemic levels. Meanwhile, because most homeowners have a fixed rate loan, the costs have not changed, even as mortgage rates have soared. So the point is, when you have a rental property, almost most of your expenses are going to be fixed, right? Your mortgage, you should be getting a 30-year fix. Property tax, insurance might go up a teeny bit, right? But what happens with inflation, let's say, for example, that you're renting a property for $1,000 a month, okay? And let's just say after all the expenses, cash flow is $200, okay? Let's say you increase your rent by $100, the equivalent of 10%. And that might take a couple of years, but let's just say at some point it increases 10%. That's an extra $100 to the top of the line. But since most of or almost all of your expenses are fixed, that $100 is going to flow down to the bottom line. So instead of cash flowing $200 a month, you're now cash flowing $300 a month. And if we look at it, your rent only increased 10%, but your cash flow increased 50%. So this is a great place if we want to be a hedge against inflation, because not only should the value of the home increase, but so should your rental income increase as well.
Well done. Good example.
Thanks.
Yeah, I like that one. That was good.
Oh, wow, compliment.
Yeah, that was good. That's good.
So Cam, let's see. Can you get close, or should we just skip you and I'll just make my last one?
Let's do the listeners a favor and we'll give you a break from talking.
Okay.
Little time out here. I'm going to jump in here. And one of the aspects that I want to highlight is control. Listen, if you guys are a control freak, you like having control over parts of your life.
No, I'm talking about you.
No, to me, no, just a little bit. All right. But if you're a control freak, right, real estate is probably going to be much more appealing to you than somebody else, right? And so some of the aspects that you're going to find under control in real estate is that you actually get to decide when you get paid, right? Is you can decide if you want to get paid via cash flow or through appreciation, typically, right? When you're buying real estate, it's going to be one or the other, typically investment. So you can decide whether you want to get paid now or if you want to get paid later, which is huge, right? Also, one of the things that you can do is you get a decision on to an extent, on the value of your investment. And what I mean by that is when you're buying real estate, there are things that you can do, actions that you can do that will exert influence over the value of your property. So you can add value to it. You can increase square footage. You can make renovations, right? You can make repairs. You can do all these things that are going to increase that market value of that property that you can't do with really any other asset class. So great avenue there. The other thing that came to mind is you have control over who you choose to invest with, right? If you come in all cash, you can invest with yourself and you have nobody else in this entire deal that you've got to speak to or talk to, make sole decisions, right? If you come in and you finance, maybe use some of those options that we discussed earlier in the show, is you're going to have to play by some of their rules, right? But you do get to choose what you're doing in that regard. But also, if you come in and you put a deal together you're going to have investors come calling, and now you've got a whole bunch of qualified candidates in which you can choose to work with. And so control is going to be a huge aspect of this. My idea of control, right, is, hey, you've got the freedom of choice. You're going to be the one doing all the research. You make the investments, and you should be making all of the rewards.
Well done, Cam.
Thanks, buddy. All right. Fasto, try and beat that. Good luck.
I saved one of the best for last. And one of the many reasons why people invest in real estate is because of the tax advantages. And that's broken down into a couple of subcategories. The first one most people talk about is depreciation. So we're buying a house, we're buying an asset. We have the ability to expense it or depreciate it over the life of the asset. And the IRS allows us to do that over 27 and a half years. So we can, in simplest terms, we just expense some of that over almost 30 years. What's interesting, this is what we call a non-cash expense, meaning you're getting that deduction not for money that you had spent out. It's for the value of the home. And again, this is kind of to piggyback what we talked about earlier. You only put in a quarter, but you're able to expense $1. Okay. Now, in addition to that, if you own a house, things aren't going to last 27 and a half years. There's ACs are going to need to be replaced, maybe some windows, carpeting, landscaping. So another option you can do is called cost segregation, or Cameron in the biz, they call it cost seg.
Ooh,
okay.
Thank you.
And in essence, what they do is someone will break down in very detail of the house, and will allow you to depreciate over different lifespans, meaning some value will be over 27 and a half years. Some will be 5 or 10 or 15. So that allows you to enjoy those expenses earlier. Also, the government loves to create tax code to incentivize or to control our behavior. And one thing they will do is, if they want people to invest more, they will make it more enticing by what they call bonus depreciation, meaning allowing, instead of spreading things over the life of the asset, you can depreciate it faster, typically with bonus depreciation in the first year. Now, that bonus depreciation changes, and I know it was great about 2 years ago. There's some talk in Congress now about increasing it. So I'm not sure where it is now, but that is a great advantage. Now, one thing I do want to talk about with depreciation, we're just replacing the time or when we're going to depreciate it. If you have a house of $100,000, we can only deduct $100,000. We're just deducting some up front, but by doing that, that means we deduct less later, right? And also, I know we're talking about the pros, but I do like to be clear of what we're talking about. A lot of people emphasize the value of depreciation, which is great, but most of the time we're going to sell that property for a gain. So what we're going to need to do is called depreciation recapture, meaning if you had written off those expenses in the first couple of years, sell it for a gain, you're going to have to recognize that income. But another advantage is they cap the tax rate on that. Let's say, for example, you're in the 30 to 40% tax bracket. You're depreciating the asset at the 30 to 40%. But with depreciation recapture, the most that's going to be taxed at is 25%. So even with the depreciation recapture, there is still some arbitrage in selling it. Also, when we sell the house, it's going to be taxed at the lowest rate, which is a long-term capital gains rate. Again, I'm assuming you've had that property for a year or more. But again, there's still ways to avoid that gain. You've probably heard of a 1031 exchange, or called a like-kind exchange. Very similar to kind of like an IRA or 401k rollover, where we just take the money from one asset and then we just move that value into a similar asset. And that just allows us to not recognize a gain. I would tell you, we are just kicking that can down the road. But I would tell you, most time I'd rather pay taxes 10 years from now than today. But wait, there's still ways to even avoid that.
What?
If you can 1035 this in theory to as long as you keep it in the real estate arena, upon your passing, your estate gets what's called a catch-up provision, meaning you might have bought this house, say this asset for $100,000. Let's say you depreciated it all. Okay. And now it's worth $1 million, right? You sell it, you're going to pay tax on $1 million. But if you hold on to it and you pass away, your children or your estate will get a step up in basis, meaning when they turn around and sell it the next day, it's going to be valued at the value of your time of death. In this example, $1 million. So there is possible to avoid the taxation on the sale of the asset. Also, with these deductions, particularly in the early years with the bonus depreciation, and also if you have a mortgage, the first couple of years, most of that payment is going to interest. Thus, we have a lot of deductions in the early years, and it's possible you can use those deductions against earned income or more W-2 income. In order to do that, you do need to qualify as what's called a real estate professional. Much easier if you have one spouse who doesn't work, right? But at the high level, in order to be a real estate professional, more than 50% of your time needs to be spent in real estate, and at a minimum of 750 hours. I was talking to a CPA earlier, and he was recommending his clients buy properties or fund a Roth IRA and then buy the property eventually. Problem is, it doesn't take a long time for you to be able to build up enough cash in there to buy a property. But also we start to lose some of these aspects we're talking about, right? The ability to leverage using that cash flow and the tax advantages. Okay, Cameron, now I'm done.
Now you're done. Well, yeah. I will say, Anthony, it is nice to have you around. You did a good job going through tax advantages there. Well done.
Wow.
Even for recovering CPA.
Believe me, when you give me, I know you compliment me all the time, like around, thank you for your help. And I don't know what I'd do without you. But when you do it, when we're recording, like that's when I know it's legit. Yeah.
Well, I zoned out for 45 minutes and you were still talking. So I figured you did a thorough job. So well done, Fasto. All right. Last one that I have. What I was going to share with you guys is that one of the best aspects, upsides to real estate, is that there is actually a very low barrier to entry. And I think that a lot of clients are typically surprised by that remark, right? A lot of times people think that you got to have, $50,000, $100,000 or more to really go out there and get started in real estate, when in fact, that's not the case. It's far from it. Even just this morning, I got an email for a rental property that was priced at just over $100,000. $102,000 is a house that you could buy Midwest, where you can come in for just the down payment. $25,000 is about what you would need to go and buy that property for down payment and closing costs. And so at $25,000 to go out there and get into the real estate game, that is a pretty low barrier to entry. Mm-hmm. And there's more.
There's more?
Yeah. You don't even need $25,000 to be totally honest with you, right? I know several guys here locally in the area that started out in real estate with zero. Right? They start out with zero through wholesaling. So wholesaling is an opportunity where you go out there and you find houses that are off market and you secure a purchase agreement with the owner. And then you turn around and you sell that agreement either to somebody that's going to buy and hold it for a while or somebody that's going to fix and flip it. So in that transaction is you don't need any money. All you need is a lot of time and a lot of energy, right, to go put forth and get through a whole bunch of phone calls to reach and find those deals. So if you look at it, to get into real estate, and if you take the right approach, is you really don't need any money. So the barrier to entry in real estate is actually very low for someone to get into it and be very, very successful in the long run. So don't let it fool you. Don't read all the articles that said you need to save up a whole lot of money to get started. In reality, you don't. You just need a little bit of effort.
Well done, Cam.
Thank you. Thank you. All right, Fausto, do you have anything to add here before we wrap this up?
Nope.
Awesome. Guys, we hope you enjoyed this episode, right? We highlighted 10 aspects on the upside of real estate. Hope you guys enjoyed this episode.
Go make it a fantastic day.
Take care.
If you like this video, I know you'll like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.